Good day, viewers. Welcome back to my YouTube channel. If today is your first time chancing on this YouTube channel, make sure you like, comment, share and subscribe for more interesting videos of this sort. Today we want to look at an interesting topic, which is a statement of financial position, which people find it very difficult to understand the concept behind this topic. Today we are here to break it down into pieces for you, my viewers, to understand where and why we prepare a financial position. Now, when we say a financial position, we prepare a financial position to know where the money of the organization went, or the money the organization owe and own, and also whether the organization make profit or is doing well, or whether they are declining. So today we are here to look at the preparation, or how to prepare the format, or whether the transaction is given, how to go about its calculation. So viewers, let's get into the video. Now, to prepare a financial statement, we first have to look at the non-current asset of the organization, the non-current asset. The non-current assets of the organization. And when we talk about non-current assets, we want to look at the items that be in the organization or that keeps very long in the organization. Ultimately, they spend over a year or more than one accounting year in the organization. And those are the items that are acquired by the owners of the organization. So with the preparation, most at times, we are being given a depreciation. Or when a depreciation is given in your transaction, there is the need for you to introduce your book value, which will be the cost, and then your accumulated depreciation, and then also your net book value. Now, when we talk of a book value, we are looking at the amount in which the organization acquired its non-current asset, and then also the accumulated depreciation. Let's say the organization used the asset for over 3 years, and then they want to dispose of the asset. Now they have to calculate its depreciation, and we have forms of calculating depreciation, which we'll be looking at in previous videos or the subsequent videos in which I'll be making. So we'll look at depreciation as a topic. But then for now, let's know that the organization will calculate its depreciation for them to deduct from the book value in order to get their actual amount in which they want to dispose of the asset. Viewers, so let's say for instance, we have a motor vehicle. Which was bought for a particular amount. And then I hope you know that we are using this symbol to represent the amount, because there is no amount being given for now. So we are using this to represent an amount of money. Okay, so the book value was given, or the amount in which the motor vehicle cost was given. Now we calculate our depreciation. We deduct this depreciation from this amount, and then the actual or the final figure, we send it, or we calculate it, or write it under the net book value. Also, let's say we were given land and building. Land and building. But then, the building has not been issued out, or has not been sold out. So, there will be no depreciation that will be calculated on this building. So, the amount in which was given, or we used to acquire the building, is the same amount that we write under the net book value, because there is no depreciation being calculated on the building. And then also let's consider let's say a patent as one of our non-current assets. So since there is no depreciation, we continue. Now viewers, let's consider this terrain as our non-current asset. So from here we add all of this We have the final or the total figure here, and then we have it this way. So let's say we are done calculating our non-current asset. So this final figure that we have here, we term it as the total non-current asset. So the total non-current asset is the final figure in which we got from here. And then viewers, you should note that the statement of financial position we are preparing is based on, or the basis of this financial position is the what? Is the accounting equation, which is the asset equals capital. Someone asks why asset equals capital. Now, if the organization begins or an investor invest their money into the business, their capital becomes the property of the organization. So we are saying the money they investors is what we are terming as the capital, and then that capital becomes the property of the organization. So we are building or we are preparing a statement of financial position based on the accounting equation. Now, right after or immediately the firm borrows money from a loan organization or a financial institution, or let's say the organization buys on credit, then it means the organization is owing someone outside the organization. So that's where we introduce liability. So then we have the asset equals capital plus liability. So we have asset equals capital plus liability because the capital, which is the owner's investment, plus the money that was borrowed from the owner, from outside organization, or which was bought on credit, when we add it to the owner's investment, it becomes the property of the organization. That is the main reason we have the capital plus liability giving us the asset. So we are preparing this whole statement of financial position based on the basis of this whole equation, which is the accounting equation. So viewers, from here, after we get our total non-current asset, we move on to the current asset of the organization. Now, when we say current asset, we are talking of the asset or the items that will have only a lifespan of one accounting year in the organization. So any item or any property that will have about only one accounting year or less than one accounting year in the organization, we term it as what? A current asset. Viewers, so we have some current assets such as the stock, or currently we say inventory. Now, when we say stock or inventory, they are the what? The materials of the organization, or the materials that are used to produce the product of the organization. So any material that is used in the course of production in the organization, we term those as what? The stock or the inventory of the organization. And then, most importantly, when we say stock or the inventory, we are talking about the closing stock or the closing inventory, which means at the end of the accounting year, what was the items or the materials that was left in the organization or that was left in stock. That is what we consider when we are preparing the statement of financial position. And then note that with the preparation of the financial position, when we talk of the current asset, we arrange the current assets in order of liquidity. When we say order of liquidity, we mean how fast those things can be changed into cash. So that means we are preparing or we are arranging the current assets in order of liquidity. And then for the amount of the current assets, because we'll be deducting current liabilities from current assets, which will give us the working capital, then we write the amount under the second currency column. So we have this written over here. From stock, we have our debtors of the organization. We have our debtors, or we say trade receivables. Or we say trade receivables. Now, viewers, note that with the trade receivables or the debtors, there can be provision that will be made on the trade receivables or debtors. So immediately there is a provision that is supposed to be made. Then that means we will be deducting that provision from the trade receivables or the debtors. And when we talk of provision, we mean the money or the amount of money set aside as the money that will not be retrieved from our debtors. So let's say we have a debtor that the organization has noticed that there could be that the amount of money that has to be retrieved fully from the debtor cannot be got. So we are supposed to, let's say, retrieve 5,000 from the debtor. But then, how things are going, or when we look at that particular debtor, we could see that we get only 4,500. So that 500 is the money that will be set aside. That should, in case the debtor did not pay in full, then we've made account, or we've made preparation for that 500 CD. That will be what? Be of debt. So we say that we deduct or we let the provision from the debtor's figure. So if we have it that way, because there will be deduction on the debtor's figure, then we write our currency here, and then we have our provision. We have our provision, and then we deduct the provision from this. And then the final figure will be transferred to be added to what? Or to be added to the stock or inventory. So we have the figure over here. Now from there, from there we move on to what? To our cash in hand. When we talk about cash in hand, it's the amount of money that the organization has in corporate, or they have in cash, the physical amount of money. That is what we are dealing with. So when we say cash in hand, that is what we mean. And then also, from there we have our bank. The amount of money that has been sent to the bank. Or someone will say cash at bank. Amount of money that has been sent or that has been saved by the bank in the name of the organization. So we have that amount of money also. And then viewers, we have something we also call prepaid. So it's a prepaid. It's an amount of money paid ahead, but then has not been in use. So let's say an organization rent a premise for, let's say, one accounting year, which is 12 months, right? But then the amount they are supposed to pay, they paid in advance. So let's say they are supposed to pay 1,000, but then they paid 1,200. So the 200 on it is a rent paid in advance. So a money paid, but then the benefit has not been used. So that is what we term as prepaid. So since it has been paid, but then has not been used, it becomes an asset or a property for the organization. So it falls under the what? The current asset of the organization. So we introduce our prepaid expenses. Then we have it also under this. Now, viewers, we also have what we call accrued revenue. When we have an accrued revenue, it means a revenue earned but has not yet been received by the organization. So we talk of an accrued revenue. Let's say the organization has performed a service for a different organization, but then that amount of money that's supposed to be paid to the organization has not yet received or has not yet come into the organization. So that amount of money, we term it as what? An accrued revenue. An amount of money earned by the organization but has not yet been received. It also falls under the what? The current assets of the organization. But then let's consider this 5. And then so from there we add all of the what? The current assets. And then we get our total current assets. So let's say we have our total current assets. From there, right after the total current asset, we need to get our working capital. When we talk of working capital, we mean we want to know the amount of money that in a short period it's operating, an amount of money that the organization is using to operate within a particular time frame or within a short period. So that the working capital is what will determine the amount of money that the organization is using to operate within a particular short period. So we are saying to get our working capital, we need to deduct our current liability from our current asset. But then as at now, we don't know our current liability. So we introduce our current liability. So viewers, let's continue. So in that same order, we have our currency sign. So let's say we have our current liability. We have our current liability. Now viewers, the current liability are the amount of money, or within a short frame, how much is the organization owing people outside the organization. So the amount of money or anything that the organization bought but did not settle the amount, the owing amount is what we are terming as what? The current liability. So we have what we term as what? Trade payables. Trade payables. Or some people will term it as creditors. They are all the same. So when we say trade payables, so we have our trade payables, an amount of money the organization is owing people outside the organization within a short frame. So that's the trade payables. And then also we have what we term as accrued expenses. Accrued expenses. So when we have our accrued expenses, we add our accrued expenses to the trade payables. And then the amount of money we have, so this becomes our total current liability. And now this is our total current asset. So by getting our working capital, it gives, or we deduct our current liability from the current asset. So working capital gives us current asset minus current liability. So since this becomes our current liability total and then this becomes our total current asset, we deduct that figure from this. And then any figure we get, it gives us our working capital. So this now becomes our working capital. Now that we have our working capital, we know the amount of money that the organization is using to operate for a short period of time. Now let's look at our total asset, the total or net total asset. So for you to get our net total asset, or we say the net total asset, we are looking at the total amount or the actual amount that represents the whole asset of the organization, or at the end of the accounting year, what is owned by the organization. The amount of money owned by the organization is what we are terming as the net total asset. So for you to get your net total asset, you add your total non-current asset, your total non-current asset to your what? To your working capital. So you add it to your working capital. I'm using WC for short. So you add your total non-current asset, the amount of money you got from adding all your total current your total non-current asset, you add it to the working capital, or the amount of money after deducting your current asset, your current liability from your current asset. So now if you add this to this figure, you get your what? Your net total asset. This then becomes your total of the what? Of the actual, or at the end of the accounting year, your total asset or resource that was left or that is owned by the organization. Viewers, this becomes the first phase of the statement of financial position. So we will end here. For better understanding, let's end here for the first phase of the statement of financial position. And then when we meet in our next video, we will look at the second phase where we will generate our capital employed of the organization. We will stay tuned for the next or the subsequent videos that are yet to be up. Viewers, as we leave it here, make sure you watch this video to the end and stay tuned for the next video. So by you staying tuned, it means you subscribe and then you turn on your post notification. So make sure you like, comment, share to your friends for them to also benefit from this fantastic video